Hello, my dear students, and welcome back. Your exams are just around the corner, and I know you're all working so hard. Today, we're going to tackle a super important topic, one that always comes up and can get you some really good marks, the cash flow statement. It might seem a little tricky, but I promise in the next few minutes, we're going to make it so simple. Are you ready? Let's dive in. Okay, before we talk about big companies, let me ask you something simple. Think about your own pocket money, right? Maybe your parents gave you 500 rupees at the start of the month. You spent 100 on a burger with your friends, another 50 on some stationery. By the end of the month, you kind of know where the money came from and where it all went. Well, that's exactly what we're talking about today, just on a much bigger scale.
You see, a huge company does the exact same thing, but with crores and crores of rupees. And to do that, they use something called a cash flow statement. You can think of it as their secret financial diary. And this diary is so important because a company can look really profitable on paper but have zero cash in the bank. This statement, it tells us the real story.
So how do they keep this big diary organized? It's not just a random list of everything. No, it's much smarter than that. They sort every single cash transaction, every rupee that comes in and goes out, into one of three big buckets. Let's find out what these buckets are. And here they are. The three magic buckets: operating, investing, and financing. It's as simple as this. Every single cash transaction a company makes, whether it's selling a t-shirt or buying a huge new factory, has to fit neatly into one of these three categories. So let's break them down one by one.
First up is the biggest and, honestly, the most important bucket of them all: operating activities. This is all about the main day-to-day business of the company.
So what are operating activities? Simply put, it's the cash that comes from the company's main business, its main hustle. So if a company makes shoes, then all the cash from selling shoes and paying for the leather and the salaries of the workers, that's its operating activity. So if you look here, cash comes in when they sell their goods or maybe get some commission. That's the plus side. And where does the cash go out? Well, for all the essential stuff: paying suppliers for raw materials, paying salaries to all the employees, and, of course, paying income tax to the government. This bucket really shows the health of the company's core business.
All right, that was bucket number one. Now for bucket number two, which is all about looking ahead, about planning for the future. This is where investing activities come in. Investing activities are all about buying and selling long-term assets, things that will help the company make more money in the future. It's just like, say you want to become a big YouTube star. What would you do? You might buy a better camera or a new phone, right? That's you investing in your future. A company does the exact same thing, just on a much bigger scale. So cash goes out when the company buys a new factory or some big machinery. And cash comes in when maybe it sells off an old building it isn't using anymore, or when it gets interest and dividends from investments it has made in other companies. It's all about building for the long term.
Okay, 2 buckets down, 1 to go. Our third and final bucket: financing activities. Now this one is really interesting because it tells us where the company gets the big money from to start and run the whole show. Financing activities are all about how a company raises capital. Where does it get the money to buy all that machinery we just talked about? Well, it gets it from its owners by issuing shares or by borrowing money, like taking loans. It's just like you. If you need money for something big, you might ask your parents for it or maybe borrow some from your older brother or sister. So cash flows in when the company issues new shares or takes out a big loan from a bank. And it flows out when it pays back those loans or when it pays dividends to its shareholders as a thank you for their investment. And you can see how it all connects, right? The cash from financing is often used for investing, which in turn helps the core operations grow bigger and better. All right, time for a quick quiz. Let's see if you're paying attention. A company purchases new machinery. Which bucket does this go into? Operating, investing, or financing? Come on, think. It's a long-term asset. It's for future growth. So, yes, you got it. It's an investing activity. Brilliant job. Now, for the part that I know sometimes scares students: calculating cash from operating activities. Your textbook shows something called the indirect method, and I know it can look a bit complicated. But don't worry, I have a super simple exam hack that will make it easy. Seriously, don't take tension looking at that long format in the book. It's not tough at all. It's really just a puzzle with 4 logical steps. I promise, after we do this, you'll be able to solve any question on this topic. Let's crack this code together. Here are the 4 magic steps. Step 1. Just start with the net profit before tax. That's our base. Easy. Step 2. Add back any non-cash expenses, like depreciation. Now, why do we add it back? Think about it. When a machine's value depreciates, does any actual cash leave the bank? No, it's just an entry in the books. So we have to add it back to find the real cash. Step 3. We adjust for non-operating items. For instance, if a company made a profit selling a building, that's an investing activity, not operating, right? So we have to remove its effect here. And finally, step 4. We adjust for changes in current assets and liabilities to see the real cash impact of our daily business. Just follow these 4 steps and you will get full marks. I guarantee it. So let's do a super quick revision before our final challenge. Remember the 3 buckets. Operating is the daily business hustle. Investing is for future growth. And financing is about getting the funds from owners and lenders. Simple! Okay, here's the final challenge for my brilliant students. Listen carefully. A company's profit and loss statement shows a solid profit of 50 lakh rupees. Great. But when they check their bank account, the cash balance has actually gone down. How is that possible? Think about our 3 buckets. Could they have spent a lot of cash buying new machinery? That's an investing outflow. Or maybe they paid back a huge loan. That's a financing outflow. See, this is why the cash flow statement is so important. It tells the real story of cash, which can be very different from the story of profit. And that's it. Our simplified explanation of the cash flow statement. See, it wasn't so difficult after all, was it? Just go through this once more, practice a few questions from your textbook, and you will absolutely ace this chapter. You've got this. All the very best for your exams.